A luxury tax in professional sports is a surcharge put on the aggregate payroll of a team to the extent to which it exceeds a predetermined guideline level set by the league. The ostensible purpose of this tax is to prevent teams in major markets with high incomes from signing almost all of the more talented players and hence destroying the competitive balance necessary for a sport to maintain fan interest. The money derived from the tax is either divided among the teams that play in the smaller markets, presumably to allow them to have more revenue to devote toward the contracts of high-quality players, or in the case of Major League Baseball, used by the league for other predefined purposes. In North America, Major League Baseball has implemented the luxury tax system. The National Basketball Association also has a luxury tax provision. Its utility is somewhat limited by the fact that the league also has a salary cap provision. The hard salary cap of the National Football League and the National Hockey League has prevented any need for a luxury tax arrangement. Methods for limiting payroll. In the Big Four North American sports leagues, National Basketball Association, National Football League, and National Hockey League, there are three different methods employed to limit individual teams' payroll: hard salary cap, soft salary cap with luxury tax, and luxury tax. Hard salary cap. A hard salary cap is where the league sets a maximum amount of money allowed for player salaries, and no team can exceed that limit. Soft salary cap. A soft salary cap has a set limit to player salaries, but there are several major exceptions that allow teams to exceed the salary cap. For example, in the case of the NBA, teams can exceed the salary cap when keeping players that are already on the team. Luxury tax. A luxury tax system does not have a limit to how much money can be spent on player salaries. However, there is a tax levied on money spent above a threshold set by the collective bargaining agreement between the players' union and the owners. For every dollar a team spends above the tax threshold, they must also pay some fraction to the league. This system is used to discourage teams from greatly exceeding the tax threshold, with the goal of ensuring parity between large and small market teams. Luxury tax rules by league. Major League Baseball. As explained by Fangraphs, technically called the competitive balance tax, the luxury tax is the punishment that large market teams get for spending too much money. While MLB does not have a set salary cap, the luxury tax charges teams with high payrolls a considerable amount of money, giving teams ample reason to want to keep their payrolls below that level. The threshold level for the luxury tax will be $189 in 2014 and will remain at $189 through 2016. From 2012 through 2016, teams who exceed the threshold for the first time must pay 17.5% of the amount they are over, 30% for the second consecutive year over, 40% for the third consecutive year over, and 50% for 4 or more consecutive years over the cap. Only 5 teams have ever exceeded the luxury tax threshold: the Boston Red Sox, the Los Angeles Angels of Anaheim, the Detroit Tigers, the Los Angeles Dodgers, and the New York Yankees. Only the Red Sox and Yankees have exceeded it more than once. Boston has exceeded it 6 times. New York has exceeded it 11 times, every year since it has been in existence. In aggregate, the Yankees have paid out some $254, 95% of the total fines assessed. The luxury tax is separate from revenue sharing, which is a system to balance out the income distribution between large and small market teams by dividing money from merchandise sales and media contracts. The money generated from the luxury tax is not distributed to the rest of the league, as is the case with the NBA, but rather is used for other purposes. The first $5 million is withheld to cover potential refunds, and is contributed to the Industry Growth Fund if no refunds are forthcoming. The remaining money is divided as follows: 50% funds player benefits, 25% funds developing baseball in countries without high school baseball, and 25% goes to the IGF. National Basketball Association. The NBA utilizes a soft salary cap, meaning there is a salary cap but there are a variety of exceptions that allow teams to exceed that cap. For example, teams can resign players already on the team to an amount up to the maximum salary allowed by the league for up to 5 years regardless of where their payroll is relative to the cap. This provision is known as the Larry Bird exception, named after the former Boston Celtics great who was retained by that team until his retirement under the provisions of this rule. The result is that the majority of teams are over the cap at any given time. In addition to the soft cap, the NBA utilizes a luxury tax system that is applied if the team payroll exceeds a separate threshold higher than the salary cap. If a team exceeds the luxury tax threshold, they must pay $1 to the league for every dollar that they are over the limit. The resulting total is then distributed to the remaining teams that are under the tax threshold. However, the luxury tax penalty is only applied if the league average payroll exceeds a separate threshold. The effectiveness of the luxury tax system at limiting the growth of players' salaries is in question. Although exceeding the luxury tax threshold costs the team twice as much money, it does not seem to limit teams' willingness to spend big money on players. As a result, since 2001 player salaries have jumped from $1.6 billion to $2.3 billion, and have outpaced league revenue growth by $110 million. At the start of the 2009-2010 season, 14 out of 30 NBA teams were above the tax threshold, with 7 at least $10 million over. Other leagues, the National Football League and the National Hockey League both have hard salary caps, making it unnecessary to utilize the luxury tax. Several other leagues in the United States and abroad use salary caps, but the luxury tax is uncommon. Footnotes